Alrighty, hi guys, Chuan Yao, can call me CY for short. So FSM1 really gave me a tough gig. I need to not just follow after passive ETFs, as well as a global view to try to tell you why Singapore is looking a lot more interesting compared to 10 years ago. So today's topic, the lion sleeps no more. Let's go. Disclaimer. So let's look at Singapore's equity market over the past 20 years. We went through, of course, the 04 to 07 commodity super cycle, and then what I like to describe as the lost decade, where the Singapore market basically was meh, which is why most people thought, hey, Singapore's not really a place to make money, it's just where you clip your dividends and then you get on with life. But then this happened, right? In 2 years, the Singapore market returned a compound return of 26.1% over 2024 and 2025. So what happened? Well, two main reasons. I'll go over the more exciting one first. MAS happened. The Monetary Authority of Singapore, MAS for short, asked themselves a soul-searching question, right? What can Singapore survive as a financial hub without a vibrant equity market, right? Can we continue to attract investors and wealth into the market if we can't list them and find exits for companies when they need to? And thankfully for me, my career, the answer to that question was no. Singapore definitely needs a vibrant equity market. And hence, they came out with this 6-pronged plan, or what I call the Equity Market Development Plan, EQDP for short. There are a lot of things, right? Singapore, very efficient, always about a solid plan. But the most important one is this, a $5 billion EQDP plan to invest into the Singapore market to really drive investor interest, as well as provide liquidity for companies who wish to list and exit at the end of the day. So what has happened? We have gone through 2 phases of this 5 billion plan. First phase, or batch 1, government came up with 1.1 billion of allocation given to 3 managers in July 25, right? As of now, only 2 have deployed. The other 1 still pending. We issued another 2.85 billion in November 25, but the funds have not been deployed yet. So that's why the header here, deployment has just started, but there is one additional kicker. When MAS issued the money to the fund managers, they said, one simple rule, I cannot be the major shareholder in the fund. There must be external fundraisings. So all this manager, 1, 2, 3, and A to F, now have to go out and find investors, retail or institutional, to pump more money into the equity market. That's basically a promise they have made to MAS. And now we are looking at batch 3, another $1 billion that's coming hopefully in the second quarter of this year, deployment probably by the end of this year. Which is why I think for the first time in forever, if you remember that song, there is now finally some excitement and some interest in the Singapore equity market. What has happened since then? We've seen the returns, right? Returns has been great. But what drove it was this. Due to the excitement and the interest generated by this MAS program, what we have seen is liquidity in 2023 basically bottomed in December 23. And since then, over the past 2 years, has seen a very significant recovery. In fact, we are at the single highest sort of trading volumes and liquidity we have seen in the past 15 years. So just here, what we can see is Singapore's annual trade value in Singapore $1 billion. And in the past 2 years, that has grown by about 43% compound in total. So I would say, even before the money is deployed, that's a pretty impressive result. Then people do ask, so does that mean market is more expensive? Of course, no questions. because liquidity begets liquidity, and liquidity itself brings in more value realization and uncovering of undiscovered gems. So this is the study done by Morgan Stanley, not by us, where they estimate that for every 10% increase in market liquidity, there should be a corresponding, call it 7% improvement in market valuations. And I think it's sort of played out roughly in this sort of category in the charts I'll show you in the later part. But the last point I would like to highlight for the EQDP and why it's so important that the Malaysian market might not understand is that different from most ASEAN markets, Singapore's pension scheme does not invest in the Singapore market. You have EPF, you have Co-op, we have CPF. CPF's mandate is to take the money and give it to MAS, and MAS then allocates it out to GIC. And GIC's mandate is to invest outside of Singapore. So this is so earth-breaking for Singapore just because it is the first time the government has decided we will take a look at investing domestically. And you can see why. If you look at the OECD study in 2002 to 2004, you can see that in Singapore, most retail investors, investor category, listed shares is barely 8%. And I bet you bulk of that is outside of Singapore. And when you look at our CPF returns, there's a reason why it's at 2.5 to 4, because that's what MAS guarantees the pension system. It is not what you get by investing overseas. Whereas if you compare it to any other pension system in the world, typically the returns tend to be higher through more volatility because you are taking on market risk. But I would think that sometimes if you're taking a longer term view, the equity market is truly the way to go. And of course, caveat, past performance does not guarantee future results. So that's the big tailwind, right? Let's talk why Singapore. It can't just be because of one tailwind that you look at the Singapore market. It has to be a holistic view. It has to be bottom up, right? So the big picture, I think, is quite clear. We've seen very strong GDP growth over the past decade, and that has resulted in Singapore having probably one of the highest GDP per capita for most amongst the world. And of course, this is really driven by the fact that Singapore has been a very conducive place to do business. It is not a surprise most companies tend to set their ASEAN or even Asia headquarters within the country. The next reason, of course, is stability, right? Currency stability has always been one of the key draw factors for the market. If you look over the past 15 years, Sing dollar probably is one of the few currencies in this region that has held its own against the US dollar. This is not a fluke. This is by design. If you look at how Singapore manages its foreign reserves, right? We are a small nation. We cannot accept the sort of volatility that currency fluctuations can bring to the economy, which is why they run probably one of the highest foreign reserves to GDP ratios in this region. And that really gives investors confidence that we can defend the currency if required. So we have growth, we have stability. Where are the triggers? Why? We see three new structural growth drivers for the economy, right? This is no longer just about the property market. It's not just about the banks, a bit about the banks, but it's really about how the Singapore economy continually transforms itself. First up, industrial sector. This is Singapore, not a manufacturing hub, right? We don't manufacture well because cost of living, cost of manpower is too high. But there is a niche. High-end manufacturing, semiconductors, right? Biomedical sciences, technology companies. They find that the high-skilled labor in Singapore, the stability of the currency, the stability of power supply guarantees them that ability to execute on their business plans, which is why so many companies have decided to put manufacturing hubs here. In fact, Micron, one of the largest DRAMs and memory chip makers in the world, manufactures about 98% of their high-end chips, a specific type, I can't remember the name offhand, in Singapore. And they're investing yet another $7 billion in Singapore to build another wafer packaging chip over the next 5 years. So that's the industrial hub angle. Utilities, data centers. Right, we've heard a lot of data centers. It is effectively the lifeblood of AI. No data centers, no AI. What you might not know is that as a city, not a country, as a city outside of China, Singapore actually has the highest concentration outside of the US in terms of data center capacity. Now, I'd like to caveat one point here. In 2018, the government was like, let's stop data centers because they were worried about a power shortage. And to them, they were so kiasu, they said, anything less than 30% power reserves is tight. For reference, Malaysia runs at 18. So they stopped the development of new data centers from 2018 onwards. So the data you see here is with no new data centers being awarded ever since then. It is only since 2025 did they start re-awarding data centers because they have now scheduled more power plants to be built out in the next 3 to 5 years. So you'll start to see this number climbing again. And the last point, this one we can't run away from, wealth, right? Family offices growth has been phenomenal. We've already exceeded 2,000 single family offices that qualify for MAS tax benefits. To get that tax benefit is a 6 months to a 12-month queue period. So you can only just imagine how many companies and family offices are still queuing up and waiting to get approval. It's not just anybody who can get approval. So why this wealth angle is quite interesting. This one is a slide to take a photo of. In Singapore, Henley and Partners, not us, estimates that there's 242,000 millionaires out of a population of 6 million. So effectively, out of every 25 people you meet on the street in Singapore, one's a millionaire. Now, this is liquid assets, not even including property. So that already shows you how much wealth has been flowing into Singapore, and which is why this wealth pillar of growth continues to be one of the strongest ones in Singapore, which again loops back to the EQDP policy at the start when I started talking about, can Singapore survive as a wealth hub without a vibrant equity market? Right, so I think it's all interconnected, and that's really two of the main pillars of growth going forward for the Singapore market. At this point, one of the questions will always come, right? Singapore's market is very dominated by the banks. I do not disagree. The 3 major banks make up close to half the index. They are very important for the growth of the market going forward. So where's interest rate outlook? That one I have to answer. If you were to look at your US Fed rate, which is the blue and green line, right, it has been on a decline. People know the outlook for this year is probably another 1, maybe 2 cuts coming from the Fed, depending on who Donald Trump puts into power as the chairman of the Fed. But the Singapore bond yield has basically collapsed. A bit of anecdote, I had to refinance my mortgage loan. My refinance rate dropped from 3.1% 2 years ago to just 1.6 6 months ago. So that really shows you how much interest rates have fallen. And in fact, if you were to look at the Singapore 10-year bond yield versus the US, we're almost looking at a 2% disparity between Singapore and equity, Singapore and US bond rates. So it raises a few questions. Number one, with bond rates, interest rates down, can the banks make as much money as they did? I would say possible, but a bit more difficult. Why? Because the banks effectively make money by taking our deposits and lending it out at a higher interest rate. When rates are higher, there's a lot more gap to play with. When rates are lower, it's a bit tough. So they're not going to make more money on their borrowing book. But that said, remember this slide? Family office? Remember this slide? Millionaires? DBS and OCBC is probably one of the best local wealth and private bank franchises in this part of the world. So I would imagine that they are already capitalizing on this, And as interest rate falls, a lot of other instruments for trading the market, a lot more interest in trading the market comes back online. So that could again generate a separate stream of revenue for them. But more importantly, what it all means is that for any other company outside of the bank, their borrow cost is now a lot lower. Their cost of capital is lower, which means investing for growth, and then the cost of funding their debt is now a lot more interesting. So I do think there's growth on earnings just coming from that alone. The earlier panel talked about REITs in Singapore. One of the key drivers for REITs, financing costs. As the financing cost comes down, effectively all that savings falls down to the bottom line, which the REITs effectively have to pay out to shareholders at the end of the day. So while Singapore banks may not be growing as fast as they used to, there are still other interesting growth companies, growth sectors that can carry the load, especially with the tailwind of the EQDP coming along. The second sector, this one I have to talk about because everybody likes to ask me about property market, right? So what has happened? 2024, 2023, high interest rates. Nobody want to buy property because at one point mortgage rates hit about almost 3.8%. Last year, mortgage rates, I'll put it this way, if you were to take a new mortgage in Singapore today, it is 1.35%. The joke is, if you were to buy a 10-year Singapore bond, you can get 2% coupon. So there is a positive carry just by mortgaging your house and buying a 10-year bond. Not that I'm suggesting that, I'm just quoting an example. But effectively, that has driven a lot more interest into the property market, and it's just a snippet of how a low interest rate environment, whilst being not so great for the banks, could drive interest and growth in other sectors of the market. And that's what I'm really trying to drive home here, that there are some growth, there will always be sectors, you just have to position correctly for them. So after the 2 years, 26.1% compound return, where do markets look like? If you were to look on a 10-year historical, expensive. Why? Because earnings barely grew. It's only in the past 4 to 5 years where all these earnings drivers has really kicked in. And you see that PE multiples have finally climbed to, I think, a fair number, considering Singapore's stability and the improving liquidity in the market. Today, Singapore trades at about 14 times price to earnings multiple, slightly below the Asia average, and more or less in line with Malaysia. So I think for a market that is generating a lot more positive growth, plus a tailwind coming from government support, 14 probably is about fair, and perhaps even more to come if the liquidity does come into the market. And this is what I meant, right? If you look at the past 15 years of earnings in Singapore, at the STI, the index level, earnings per share between 2010 to 2019, pre-COVID, no growth. So there is no wonder why the market didn't move. There is no earnings growth to support a market re-rating storyline. But we have seen that change in the past 2 to 3 years. Earnings growth has come true, and the forward estimates by Bloomberg Consensus, which basically surveys the brokers' simple average earnings estimate for companies within the STI, is projecting somewhere in the range of, call it 5 to 7% earnings growth per year, right? So you have the earnings growth hopefully coming through, assuming nothing happens. The second last point to really flag here is dividend. Singapore is known to be a dividend-paying market. Our market yields anywhere between 4 to 5%, depending on how you want to look at it, forward basis or trailing basis. And this is important because when you look at the Straits Times Index, it is a price index, which means whenever they pay out a dividend to investors like us, the index drops, right? It is not a total return index like the MSCI World Index. So when you look at the price return, which is here, you really see the kicker only come in the past 2 years. It's more or less flat, as what we've seen at the start. But the dividend is really where a lot of the returns come from. So you're not just getting a bit of growth coming through, you're also getting a pretty decent coupon, especially when you look across the market in Asia, where Singapore on a trailing basis is giving you about 4.2, And then if you're adding growth, you're looking at about 4.4, 4.5, 4.6 on the next year basis versus the rest of the Asia markets. So I think that's how Singapore market is positioned. And I think the sleepy lion is probably starting to awaken. Last slide here is a bit of tongue-in-cheek, just to show you how the markets have performed in ASEAN, right? Over the past 10 years, dark blue line representing Singapore. To be fair, most of the returns came in the past 2 years, where effectively a dollar invested in 2015 would give you about $2.40. And a dollar invested in ringgit terms will give you about 250. So there's still the currency storyline at play as well. Okay, with that, this is actually my last slide, short and sweet. Hopefully that really gives you an understanding of the Singapore market. Thanks all.